Understanding the debt-to-equity ratio in home mortgages. The debt-to-equity ratio is a fundamental concept in corporate finance used to gauge a company's financial leverage by comparing its total liabilities to its shareholders' equity. However, this same principle can be strategically applied to personal finance, specifically in the context of a home mortgage. When assessing a homeowner's financial health regarding their property, the debt-to-equity ratio is adapted to compare the outstanding mortgage debt, the liability against the homeowner's equity in the property, the asset's value minus the debt. This ratio provides a quick snapshot of how much of the home's current market value is financed by debt versus how much the owner actually owns free and clear. A higher ratio indicates higher leverage and potentially greater risk for both the lender and the homeowner if property values decline. For a homeowner, the debt component of this adapted ratio is straightforward. It is the current unpaid principal balance of the mortgage loan. The equity component, however, is dynamic and is calculated as the home's current market value minus the unpaid principal balance. Equity is essentially the money a homeowner would pocket if they sold the house today and paid off the loan. As the homeowner makes regular mortgage payments, the principal balance decreases, which generally causes the equity to increase. Simultaneously, market fluctuations can change the home's value. If the value appreciates, equity increases, and if it depreciates, equity decreases, potentially impacting the ratio significantly. Understanding the interplay between principal paydown and market valuation is crucial for managing this personal debt-to-equity ratio. Lenders and financial planners use this ratio, often in conjunction with the loan-to-value ratio, to assess financial stability. For lenders, a low debt-to-equity ratio, meaning high equity and low debt relative to value, signifies a lower risk, as the homeowner has a substantial financial cushion. In case of default, the sale of the house is highly likely to cover the remaining debt. For the homeowner, a low debt-to-equity ratio indicates greater financial freedom and flexibility, such as the ability to refinance with favorable terms or access a home equity line of credit. Conversely, a high debt-to-equity ratio, especially one approaching 1-to-1, where debt equals equity or 50% loan-to-value, suggests that a relatively small drop in the home's market value could lead to the owner having negative equity or being underwater, a financially precarious position. Ultimately, the debt-to-equity ratio serves as a powerful metric for monitoring a homeowner's most significant asset and liability. Actively managing this ratio, by making extra principal payments, accelerating the amortization schedule, or simply tracking local real estate trends, is a core tenet of responsible personal finance. A strategic goal for many homeowners is to consistently drive this ratio down over time. This reduces the overall financial burden, builds wealth, and reinforces long-term financial security by increasing the owner's stake in the property. It transforms the home from being primarily a debt obligation into a solidified and growing asset. We welcome you to subscribe to our YouTube channel for more informative videos on finances and taxes. Thank you.